Hello and welcome to this special edition of Biz Talk on CGTN. I'm Lulu. We're coming to you live from Beijing. Major economies are walking a tightrope trying to curb inflation without sinking their economies. The US Federal Reserve, the European Central Bank, and Bank of England all hiked interest rates in a prolonged battle against stubborn inflation and amid mounting recession fears. So can the US and Europe tame the persistent inflation woes? Can we expect the tightening of monetary policy in major economies continue for the whole year of 2023? Joining us today, we have Dr. John A. Quelch, Leonard M. Miller University professor from University of Miami. Welcome to the show. And Miami Herbert Business School, that is. And then we have Mr. Mark Ostwood, Chief Economist and Global Strategist of ADM-ISI. He's joining us from London. And Chen Jiahe, Chief Investment Officer of Novemmarket Technologies. Gentlemen, welcome to the show. We hope we'll be discussing the major monetary moves and also share their perspectives on year 2023 global financial outlook. So welcome again. Gentlemen, this week, the past week has been a packed week. Somebody dubbed it as the central bank week because with some major policy decisions coming from major central banks around the world, including the Fed, European Central Bank, and the Bank of England. So that rate decision is affecting the daily lives to everyone who's living in those countries and living outside those countries. So I want to start by asking John and Mark, what is your life like there with all that high inflation? Let's start.
Lily, thank you very much for the opportunity to be with you. So I think you have to look at it segment by segment among the consumer market. First of all, you have some people who are comfortably well off and whose lifestyle really hasn't had to adjust to the economic circumstances. You then have a second group of people who are looking at their pension plan returns for 2022 and feeling a lot of nervousness about their long-term future, possibly therefore cutting back on luxury and discretionary expenditures. You then have a third group of people who are relatively low on the income scale, and they are feeling it really hard because they have to endure food price and gas price inflation, and those commodities constitute a large portion of their weekly disposable income expenditures. So they're the people who are really getting hit hardest. There's another group of people who are younger people who are in service jobs. And because of the tight labor market in the US, especially in the service sector, those folks are finding that their wages are keeping up with price inflation. So it's not a homogeneous answer. You have to look at these four consumer segments individually.
All right, great insights there. Let me go to Mark there. I know you living in London, you're also traveling across European countries, and the strikes are actually erupting across Europe right now. That partly, of course, is because of a rising inflation. What have you been seeing there?
I mean, I think the biggest pressure for everybody, it is, as John was outlining, it is the fact that all the inflation is in the non-discretionary areas. It's not on things which you can easily cut back on. We can't cut back that much on food. There's only a certain extent to which people can cut down on heating. And that's really where, it does, as John said, impact people very differently. I think the biggest problem for the UK is that in real terms, wages actually haven't really been growing much at all since the global financial crisis. So this is effectively dotting I's and crossing T's of a crisis that's been brewing for years. In Europe, the picture is much more varied, but the inflation is very much there. It's hurting people just as it is in the UK. But in the UK, there are structural issues related to Brexit which haven't been resolved. There is a huge hit to the potential economic growth as outlined by the Bank of England and many others. In Europe, it is more to do with the fact that that they are being hit above all by the energy price crisis, the energy crisis in Europe, which, to be honest, is an energy crisis worldwide, but it's Europe which created this dependency on cheap Russian resources, which it's no longer has access to, and so we're in a complex situation for Europe, because it's not actually doing that badly. The labor market, by comparison to the prior Euro crisis, is actually very, very tight. So this is also a demographics issue. So there are lots of layers to this, but people's feeling of the cost of living crisis is clearly being felt, and that's why we are seeing so much labor unrest, and it's likely to continue throughout the year.
Well, I guess you gentlemen, John and Mark, you both would probably be envying Jiahe, someone living in China, because in China, consumer prices have been kept within a reasonable range. We didn't see a drastic rise in inflation. So Jiahe, just very briefly, we're going to actually go back to this point later on in the show, but right now, let me ask you, why do you think China managed to escape the global inflation in year 2022?
Well, that's a very good question. We are pretty lucky that we didn't have the rising inflation that's like 8 or 10% that we have saw somewhere else. I think the biggest reason when you look at why China has been so lucky to escape from the global inflation is that the money printing in the year of 2020 and 21, where the COVID was hitting the economy the hardest, we didn't print much money at that moment in order to save our economy. We tried other ways. We tried a lot of other ways, but we avoided the growing of our monetary base to like 20% or even 25%. We had it for about 8 to 10%, while the Chinese economic growth was like 5 to 6%. So we have the M2 growth at 8 to 10%. That was quite moderate. So we didn't have the inflation after that. One other reason might be that also China has various sources of energy import. We import a lot of energy from Middle East and everywhere else, South America, Australia. So we're not that strongly affected by the war between Russia and Ukraine, like many European countries have been.
So we're going to actually come back to how China is going to navigate through this special time, especially after the country's full reopening of its borders later on. But now since we were on the topic of what happened in year 2020, so let's go back a little and take a look at the rate hikes there. So after the latest rate hike of the Fed, consumers in the U.S., they will be paying about $450 more in borrowing cost for every $10,000 that they in debt. That was compared with more than a year ago. So what kind of evidence do you think the Fed or the BOE or the ECB is looking for until they can start tapering or change directions in their policies, gentlemen?
If I may, Lily, the Fed, as expected by the markets, increased by 25 basis points a couple of days ago. And I think the markets believe that there's another 25 basis points coming in the next Federal Reserve announcement. But beyond that, I think the markets are quite optimistic that there will then be a pause in Federal Reserve rate hikes. And the reason why the markets are optimistic is because there is strong evidence of consumers slowing down in their total spending. As you know, consumption is around about 65% of the US GDP. So what consumers do is very important to the heat of the economy. And we did see in the month of January, US retail sales falling by the most amount percentage-wise in a year. And other indices of manufacturing activity and procurement, advanced procurement of raw materials, these indices are also down, along with consumer confidence. All of this means that combined with rising mortgage rates, which have effectively stalled the housing market entirely, all of this means that the economy is slowing down very nicely. And to avoid an overshoot, the Fed will, in my opinion, pause after the next 25-point rise and see just how effectively its series of rate hikes have impacted the heat in the economy and the hopeful reduction in inflation down towards the eventual 2% target.
So, John, do you agree that we might see another rate hike in March and then
Yes.
possibly that this hiking cycle would be paused?
Yes, one more rate hike in March, and then I would expect a 3-month pause to see how those prior rate hikes have impacted the inflation rate.
And that is your prediction on the Fed's move or other central banks as well?
Well, I'll leave Mark to comment on the BOE.
Yes, go ahead, Mark, please.
Okay, yeah, I mean, I think the interesting aspect of all those 3 central bank meetings was the fact that they didn't push very hard back on markets' expectations that after however much more we're going to get in the way of rate hikes, that they're going to cut rates by the end of the year, which that is an actual significant change. But in terms of the Bank of England, we've had the chief economist this morning talking about the need to avoid overshooting, which is a fairly strong signal that there may be one more rate hike in March from the Bank of England, but not much more. By contrast, the ECB, I should add, though, that there are risks with that in terms of the Bank of England, simply because inflation is stubbornly high in the UK, as it is in the Eurozone. And the ECB was, to a certain extent, a good deal more hawkish on the rate outlook, signaling already basically that it intends to hike rates by another 50 basis points in March, and then it will reconsider. But I think what it's talking about really reconsidering is not moving as quickly in terms of rate hikes, i.e. it moves in May by 25 basis points. And the assumption is that they may well stop after that. In all cases, it is the case that it's a pause. And I think within all of this, the key aspect, and to a certain extent, China is way ahead of the curve here, because China's had the experience of the housing market, and that is an experience which in Europe, that's both Eurozone and UK, and the United States, this housing market downturn, which was effectively the biggest bubble blown by all the quantitative easing that there was, it could have a very material impact on how interest rates evolve later in the year, because there is a vulnerability there pretty much across any parts of the Australia, Canada, North America, Europe, to a sharper housing downturn.
And speaking of the property market, you talked about how China is ahead of the curve compared with European countries. So let me go to Jiahe now. Jiahe, I know you have been following the property market closely. Tell us what's going to happen next when China is fully reopening its borders and fully reconnecting with the global economy under certain risks of importing inflation.
Well, when we look at what's coming in this year, it is very possible that we will see a full recovery of the Chinese economy, basically because in 2022, our economic growth was not very good. So we had a very low base if we look at year-over-year growth. I mean, this year, when we look at the economy, we think that the consumption will very possibly rebound very quickly when China has removed all the anti-COVID policies that restricted the mobility of people. From this Spring Festival, we have already seen that the number of tourists have increased to almost to the level of 2019. So it has been a huge amount of tourists in Hainan, of course, that we have saw here. The hotels rent to like thousands of RMB per night. So the consumption definitely will provide a lot of support to the economy this year. the investment and the investment will keep on going, which is another large sector of our economy. Finally, there comes the question of export. Some people believe that export might not be as good because we have seen economics, the slowdown of economic growth in both North America and Europe. But there is another thing is that the Southeastern Asian countries have got pretty good economic growth in recent months. That we can see economic growth being pretty fast in Singapore, in Philippines, and these countries are very important trading partners of China as well. So the export might be okay. I mean, it might not be that bad, given some people are pretty pessimistic about that. So overall speaking, we will have a pretty good year for 2023. And we have seen the stock market been performing quite actively toward that. But when we look at the property market, we might not be able to see a rising property price, because that's one thing is that China's property price is already quite expensive. I mean, if you compare the property price in Shanghai and Beijing to the average salary down there, is actually pretty high price, and the government have actually noticed that. So it's quite a lot of financial derivatives have been cut off, that we have stopped the accumulation of financial derivative on the property market. So I mean, the property market might perform quite flat this year. That's my guess.
Okay, so Jiahe, you talked about how export will continue to be a major driver of China's economic recovery going forward. Speaking of export, I want to go to John. How do you think the latest or the slew of Fed's rate decisions, including the latest ones, including in the context of a prediction of a slowing down in tightening policy directions, how is that going to affect U.S. trade with China?
It could have an impact on consumption, and consumption, of course, is very much related to imports from China. You know, one of the things, though, I always caution about is that China has done a very good job of becoming essentially the factory to the world. We all know that. And when consumers are under pressure, they are more price sensitive, and so they're looking for value. And there's no better source of value when it comes to manufactured goods than China. So I don't believe that there is necessarily going to be much of a slowdown in terms of exports from China or imports from China into the US. You know, one thing I just might add, if I may, Lily, to put a little bit of context around the relative growth rates of the different parts of the world. The latest forecast from the IMF, I think, if I remember rightly, is forecasting 2.9% worldwide growth for 2023. Yes. And that includes 5.2% for China, whereas the US and Europe are around about 1 to 2% maximum, with the UK being, of all of the G7 countries, the one that is forecast for negative GDP growth, marginal but negative GDP growth in 2023. So what we've heard already to the effect that the Asian economies, not just China, but the other Asian economies, are also in fairly good condition for growth this year, as well as Middle East and Africa. You know, it's interesting that collectively, these economies are going to be the drivers of the 2.9% rather than Europe or even the US.
Well, that's interesting. And before we, actually, since we're on that topic already, let's talk about other growing economies and, I mean, in other parts of the world. Mark, let me go to you. So we have been talking about the Fed's rate hikes and its impact on the global economy, especially in other low-income countries or emerging economies throughout the year of 2022. And now, with the Fed seemingly likely to continue its rate hike for another few months, probably into the first half of the year, into the summer, where do you think that impact stands right now? And what's going to happen to the US dollar in the near future?
The dollar, there's sort of the dollar is always subject to a number of forces. There's the background one, which I think people always don't really quite take enough attention to, and that is basically if global trade growth is robust, even if we're talking about the way that payments are made starting to change, but that's a different subject, then the dollar tends to weaken, because people recycle a lot of their dollar earnings into other currencies. When global trade growth is weak, as it has been, then the dollar tends to be strong. It's something, I suppose, which some people might find a little perverse. On the other hand, the other factor which always drives it is interest rate differentials. What are people's expectations on interest rate differentials? And one of the dollar's weakening, the part of the weakening that we've seen in the dollar so far this year has been predicated on the idea that there will be an element of catch up, above all from the Eurozone, in terms of interest rates rising closer to US rates, and therefore giving the euro a bit of a boost. The idea was the UK obviously has rates close to the US in any case. So I think in terms of how this impacts, it really is going to be people focusing in on how much global, will we see a real boost to global trade from Asia? I think, China and the rest of Asia, which looks to be, it's by far the most agile, by far the most dynamic part of the global economy. The other parts are so lumbered with debt that they are struggling. And in certain emerging market countries, obviously, the emerging market outlook is very, very differentiated. You've got countries in crisis like Sri Lanka, like Lebanon, Ghana, Zambia, and you've got other countries which are actually doing very well. More of those tend to be in Asia than they are elsewhere. So it is a very differentiated outlook. But I think overall, barring a debt crisis, which would see huge demand for the dollar because most of the world's debt is denominated in dollars, the dollar's probably peaked for the time being. But I don't think this talk of the dollar basically having a massive reversal this year is really that likely at all.
Okay, let me get the Jiahe's take on that. Do you agree that the dollar may have peaked already for the short term, Jiahe? And also, John and Mark, they both mentioned how the major growth drivers of the global recovery would be focusing in Asia. So speaking of that, Jiahe, what is your take on that? And also, what is going to be the possible impact on China's currency?
Well, I think the dollar is one of the hardest things to predict. I try to avoid, predicting the movement of dollar with my investment. It's really difficult. I mean, we have saw the dollar being rising quite a lot last year, and suddenly it just came down, and about half of its rising has been erased since its peak. So into the future, it's pretty hard to tell where the dollar is going to be. I mean, there are so many uncertainties there. Will the war end in Europe? Will the inflation get contained? Will the unemployment be staying at this low level right now? And will the economic growth be picked up again? So it's really hard for me to predict where the dollar is going to be, I mean, to be honest. But when you talk about economic growth, yeah, I mean, the world's engine would be with Asia. That's right. I mean, one part is China, the other part is all the Asian countries. I mean, look at the growth of Malaysia, Indonesia, Singapore. I mean, Singapore's, even the property price in Singapore has been rising so rapidly in recent year. So yeah, I mean, the Asian growth will definitely bring the world out of the economic trough in the future. And when we look at the impact to China, the RMB will try to pack with the dollar in order to favor China's export and import. I mean, a large shift between the RMB and the dollar is, well, it's a very bad thing I think for every country in the world. I mean, China doesn't want a rising RMB because that will decrease the competitiveness of our export. But if the RMB drops a lot, the US will not be happy. So, well, some people said that the most important relation right now in this world is the relation between China and the US. So with currency, I think it's the same thing. I mean,
between the US dollar and yuan, right?
Yeah, between the dollar and yuan. If this currency rate is fixed with a stability that we don't see a rising dollar, neither we see a rising RMB, then that might be the best for the global, the international trade.
So, Zhang, it seems like throughout the year of 2022, what many analysts, observers, and traders had been watching closely are basically two things: that is, inflation and then rate decisions. So, would that be the case in year 2023?
Well, I think the inflation in 2023 will not be as important as last year, because last year we have solid inflation being skyrocketing. You know, people don't know where the inflation in the US will be. It's reached 8%, will be 9%, will be 15%. I mean, remember in the 1980s, there was a huge inflation of, I think it's around 12 or 15%. So people didn't know too much about where the inflation will be last year. But now with the hiking interest rates throughout the world, the ECB, the Bank of England, the Fed, everyone has been using the interest rate hike to contain inflation. I think the inflation will not be as serious a problem as it was back last year. Also, the impact from the Russian-Ukraine war is now eliminated. The impact is reducing. So we don't have that large impact from this war right now towards an inflation. So the inflation will not be such a big concern this year. But when we look at the economic growth rate of England, or of the United Kingdom, of America, we see this growth rate is actually coming downward. So maintaining the growth rate might be a more important issue this year.
So speaking of the Russia-Ukraine conflict and its impact on the global economy, let me go to John. So inflation, this round of global inflation that's been running through the roof, is partly attributed to the Western sanctions on Russia. Do you think this might somehow impact future sanction decisions?
The Ukraine crisis really has had two principal impacts. It's impacted consumers in the energy sector, and secondly in the food price sector, because Ukraine is such an important agricultural producer in many categories of commodities. Now, on the energy front, the Europeans have developed a whole host of coping mechanisms that they have attempted to implement. And of course, they have been assisted by the relatively mild winter so far, which has meant that the worst fears regarding energy shortages and price increases have not been realized, at least yet. So that's point number one. On the food inflation front, in a sense, the Ukraine crisis has been a bit of a windfall for other producers of some of the major commodities that Ukraine is well known for around the world. And again, substitution has occurred, but there are significant supply chain challenges associated with these substitutions of supply sources for these agricultural commodities. And as a result of that, the inflation in the food price area is not, I think, going to necessarily abate that quickly. Or at least, let me put it this way, we're not going to see food prices collapse back to where they were before, because these disruptions are ongoing and they do take a significant amount of work to adjust to. So I think that additional sanctions, Lily, you mentioned, honestly, I'm not sure how many bullets there are left in the chamber of the gun to be fired. Pretty much everything that could be done has been done. What has been lacking probably is enforcement of the sanctions that have been mandated. That's where there's probably more room to tighten the screw, but coming up with new ideas for sanctions at this point, I don't see it myself.
Let me let's stay on the topic of the energy crisis. Let me go to Mark, because you're the one who is in Europe going through one of the coldest winters in a long time, with probably limited supply of energy. So have you noticed the amount of Chinese exported products in Europe that is helping people to go through this cold winter, that has become very popular there right now? And also, what I want to hope to discuss that by China trying to keep its consumer prices, its inflation within a reasonable range, what does that do for the world?
Okay, I mean, the energy crisis, I should probably just add here, is not just a function of the war in Ukraine. The energy crisis in Europe is due to structural underinvestment and chronic dependencies, which were never, there was no fallback plan. So that's what they've had to rush to do. So Europe has been lucky that China has had that reduced period of activity in the economy, because it's helped them to get through this winter and brought down gas prices because there wasn't that demand. That's obviously going to change this year. As the Chinese economy picks up, there will be more competition for energy resources between Europe and China, and that will be tangential to the European energy price outlook. The other part, of course, which people need also to remember in terms of driving inflation down in Europe, is so many of the governments have very, very expensive subsidy programs. And given the level of budget deficits that there are, most of them, as the energy prices come down, will have to be jettisoned. So that will actually counter the effect from what we see in the markets. And that brings me on to the other topic of food prices, which you were mentioning, which is, and this is very important across the world, but the food price pressures, we had the UN FAO food price index this morning coming down for a 10th month in a row, but that's only the raw materials. The real problem here is a lot of the food producers actually also are contending also with those high energy prices and rising wage costs. So actually food price inflation, I suspect, may be the bigger issue this year than actually energy prices to a large extent. And at the end of the day, when we're talking about geographies, it is the country, what I'd call the so-called non-aligned countries, the likes of India, the likes of the GCC countries around Saudi Arabia, who will benefit most from this, because all that displacement of supplies is basically always plays into their hands, while Europe basically says, well, we're not going to import anything from X, Y, or Z countries, which basically elevates or keeps the floor under how low prices can go, simply because they're not actually able to say, right, well, we want to source this from the cheapest place possible because there are sanctions in place.
Mark, do you think that the UK and the US, they're relatively less sensitive to tightening financial conditions as compared with trade-heavy countries like Japan or Switzerland?
I think the US is always much less sensitive to anything on the trade front, because trade doesn't, the US is, it can depend on itself. It's obviously not in its interest to trade as good. For the UK, everything is, the UK is so dependent on imports of everything that it's really very, very vulnerable. And I don't think the tightening of financial conditions will have much more of an impact. And the same is actually true of much of the EU. There are, Europe is dependent on vibrant global trade. It needs to import a lot of the resources, which it can then resell as finished products. And at the moment, the high base costs that have been introduced by the energy crisis are leading to a lot of European companies thinking about whether they actually need to relocate. And that doesn't actually, that basically means there's going to be more long-term structural problems for Europe unless they can actually come together. And this is what the problem is at the moment, that the EU is still very divided in terms of interests, and it can't seem to find a cohesive response to how to ensure that this energy crisis doesn't repeat itself in the future.
John, can I get your take on that same question, please? The U.S., as Mark mentioned, of course, it is because of the size of its market and its resources. It is, let's say, a bit more or relatively more self-reliant, so hence it is less sensitive to tightening financial conditions. Do you think that is why the Fed has been quite bold in its rate moves?
I don't think that's necessarily the case. It is true that, as Mark says, the U.S. economy is pretty self-sufficient, and particularly with respect to energy, and that's perhaps one reason why the inflation rates in the U.S. have not been as high as they have been in Europe. But the Fed's approach, I think the Fed understands that it has a global responsibility as well as a U.S. responsibility, but the U.S. responsibility is primary. And if the U.S. economy is put back into a good condition, that's going to be beneficial to the global economy. Notwithstanding the fact that a relatively smaller percentage of GDP in the U.S. is devoted to trade or emanating from trade than in a significant trading nation such as the United Kingdom or the Netherlands, for example. So I think the Fed does have its sights on the global economy, because a good global economy is good for the U.S. economy and vice versa. But fundamentally, its mission is to deliver employment levels and inflation levels that are commensurate with its mandate. I think one of the challenges, if I may, Lily, at the moment is to make sure that the Fed doesn't take its foot off the pedal too early. And there is some talk about long-term target inflation rates being adjusted to 3% as opposed to 2%. I personally think this would be a big mistake if the Fed were to go down that particular path, because what it will say to the markets is that the Fed doesn't actually have the stomach to solve the entirety of the problem, and might be subject to political influences that would be arguing against a really tough tightening that would solve the inflation problem. So that's, I think, a note of caution in the current environment that we should underscore.
John, would you say the rate hikes last year had been successful?
Yes, I would. Now, it does take 4 to 6 months to see how these rate hikes play through in terms of the inflation rate. But my belief is that although the Fed was late to the game and didn't get onto the problem quick enough, that nevertheless they have really, I think, been very consistent and focused in the last year. And I think also they've been sending much better signals to the markets through the statements made by the chairman, Jerome Powell, compared to when he first started in his position, where there were several very significant communication snafus that spooked the market. Now that all seems to be under control, and there's very clear messaging from the Fed. And I think the markets have learned also how to calibrate their interpretation of the words that the Fed chairman uses.
Do you believe that the worst is over?
I always believe the worst is over. That's why I live in America.
We could use some optimism for now. Great insights. Jiahe, let me come to you. So we know that inflation, rate hike, of course, is not the only solution to inflation. So what kind of tools, or do you think that China's central bank would have more space and more tools if they wanted to hedge against inflation?
But when we look at the methods that, well, both China or United States doing to curb inflation, definitely the rate hike is the most common and the most effective way. I mean, that's with the economic textbook. But when you look at other ways that China's central bank would be doing if there is an inflation, well, we don't have any inflation to curb right now. We worry that if the price go down too quickly, we might have a problem. Then we might want the inflation rate to reach like 2 or 3%. But currently, if there is an inflation, there would be some other ways that the central bank in China could be doing. One way is to curb the loan, to try to curb the loan. China's banking system is mainly composed by state-owned banks, the very large ones like the ICBC, the Bank of China, Agricultural Bank of China. These are very large banks of China. They contain about 80 or 90% of the market share. So it would be possible that if the central bank wants to contain inflation, to ask them just to reduce the monetary supply. So that's a very effective way. The other way would be increasing the supply if the inflation is caused. For example, if you look into the past few years, in many cases, the Chinese inflation was actually there because of the rising of the pork price. That's a very, very interesting economic sign that China's Statistics Bureau never published the very detailed percentage of each commodity with our CPI, but it is estimated that the pork price used to take like 30% back 10 years ago, and now still probably contain like 15 to 20% weight of China's CPI. So sometimes when the pork price rise up, like with the swine flu that hits the China's production of pork, you will see the CPI rise up. It's actually not the result of a monetary thing. It's not because we overprinted money, but that's because we've been short of the pork. So in that case, increasing the pork supply would reduce the inflation. So I mean, these are the very common ways that we have been seeing in the past. But currently, we don't have an inflation to deal with right now. But if the inflation really comes back, these tools would be useful.
Jiahe, what kind of potential risks do you think China is facing from economic policies from major Western economies? And what can be done to eliminate those impacts?
Well, I think if you look at China's relation with the global economy, I mean, the Western economy is a very large part of it, is that the biggest potential challenge that China might get is, with a potential economic slowdown across the world this year, which has been anticipated by the World Bank, IMF, all these institutions. If the economic growth really goes downward, then China's export might be facing a problem. I mean, currently China is really focusing on the export and import. I mean, we're called the world factory. We import a lot of things. We produce things here when they sell them out. So if the global economy really comes downward, then China would be having a problem with our export. But I think that this is not a very big challenge this year. The first reason is that the U.S. economy and the European economy might not be that bad. I mean, if the Ukraine crisis is over, then we might have a very bullish year for Europe this year. So and the second is that the Southeastern Asians are actually picking up with a very high growth rate. I mean, Philippines is growing like 7% this year. So they are big trading partners of China. Another thing is that Chinese consumption is definitely picking up this year because of the removal of the anti-COVID blocking policies. So this is not that big a challenge. But if you talk about the largest challenge coming from the global economy to the Chinese economy, then export is somewhere we want to look at.
Oh, great stuff. Good talks, gentlemen. I still have a few more questions to follow up. Let me first go to John. John, what evidence do you think the Fed is looking for before it can start tapering? And also, what is your outlook for the U.S. economy this year?
So I think that the U.S. economy is actually going to outperform the IMF forecast. I think that the markets have baked in an expectation and an optimism, an expectation of better performance and a quicker recovery from what may be a shallow or a marginal recession at the most. So I think the Fed, to your question, it's definitely looking primarily at the inflation rates and the forecast and those metrics that are precursors of consumer price inflation. That's how it's calibrating its approach to further rate increases. I think, as I said earlier, there's going to be one further rate increase and then at least 3 months without a rate increase. And the Fed is going to take stock at that time. I'm pretty optimistic that we've seen the worst of the challenge.
Okay, Mark, some are saying that the outlook for the European economies, or the Eurozone economy rather, is not that rosy, that the economy probably is entering a stagnation status. Do you agree with that?
Yes, I mean, yeah, I think there's been a lot of elation around the place in financial markets about the Eurozone economy, that it's not gone into the sort of recession that everyone was talking about just about 3 months ago. On the other hand, we are talking about the difference between, well, if it's plus 0.2 as opposed to minus 0.2, is plus 0.2 good? And the answer is no. So I think we're looking at a period of slow growth in the Eurozone. I think predictions for the UK, rightly, given the lack of stimulus from government and the very tight fiscal policy that's being applied, in the UK will likely be just slipping down the hill. But it's literally slipping. In both cases, it's not going to be the sort of recession that people were really fearing. But on the other hand, there isn't much to suggest that there's going to be an improvement in the growth dynamic. In terms of what the ECB does, I don't think it's necessarily that focused on the growth outlook, but I do think it is now concerned with the stubbornly high level of inflation that's been there, about wage growth. And we were talking beforehand about the strikes across much of Europe. And they are, how those get settled will basically dictate to a certain extent how much the ECB can actually respond to any slowdown in growth and how stubborn it will be about trying to fight the inflation. Even though I would stress that most of the problems in Europe are really not demand related in terms of inflation. They're supply and they're investment related, and there's not really there's no amount of money printing or rate hiking that the ECB can do to change that. That's down to politicians.
Mm-hmm.
Mark, could I just quickly ask
Sure.
you to comment, if I may, Lily, on the concept of declinism, which is a word I had not heard previously, but it refers to, I think, the psychology in the UK of the UK being in decline. And of course, we know that consumer psychology can have a big impact on whether or not the economic realities actually play out.
I think that is, as much as all the politicians in the UK and indeed, Europe is just as much impacted by this. They won't admit it. The fact is that they are going through it. In the UK, I think it has an additional problem because there hasn't actually ever been a proper reconciliation with getting away from its colonial past, i.e. its empire. And there hasn't been this admission that within the greater scheme of the global economy, having chosen to leave the EU, it is not that significant a part of it. It's something which happened, actually, if people want a good look in the history books, go and have a look what happened to the UK economy during the 50s and 60s, when it wasn't part of the emergent EU. Europe, Europe's challenge is basically, I think, in the longer run, if it can't address this energy problem, it is going to see the same thing that happened in Japan, which is basically a hollowing out of its industrial base, which for Europe is actually going to be very bad news.
All right, great insights there. So sentiment is very important. As we always say, confidence is more precious than gold at some times. So gentlemen, my final question to you, what would be your piece of advice for global investors in year 2023? Can I start with Jiahe, please?
That's a very, very good question for me, because I've been thinking about that every single day. You know, my job is to invest. Currently, I should just tell you my holding. You know, currently I have 65% of my holding in the Hong Kong market and 35% in Asia. So my holding tells you my advice, which is Hong Kong. I mean, if you look at the equity valuation in Hong Kong right now, currently my valuation. The valuation of my portfolio is now trading at about 5 times PE ratio, 0.45 PB ratio, and around 7% dividend yield. So that's a very amazing valuation if you look at that, and consider the fact that these companies are actually increasing at about 6 to 8% per year. So that's probably the lowest valuation you can find in the world right now. I mean, offering you like almost a 7% dividend yield with a large portfolio consisting of 40 to 50 companies. So I would say, well, looking at this year, I would just ask everyone to do the same thing as me, because I have been doing it. So just try to find the good companies in China with very low valuation, and spread your portfolio with 30 to 40 companies to spread your risk. I think that's the best choice that people can have right now, according to what I know.
Well, good luck to you on that front. John?
Buy technology selectively anywhere in the world where you can find a great company with a differentiated idea and great leadership.
Okay, Mark?
Yes, I think technology, above all in areas, we've used technology for convenience up until now. I think the focus now is to use the technology that we have to apply it to improving our infrastructure in the broadest sense of the word, whether it's energy, whether it's education. There are huge opportunities there, and also to look at those countries which are going to benefit most from displaced global supply chains, because there are countries which are going to benefit disproportionately a lot from that, and India and the GCC countries, and obviously Asia, I think are going to be huge beneficiaries.
Well, of course, tech is the new black. That's a really interesting piece of advice. Thank you so much, gentlemen. So it seems like tightening financial conditions to curb inflation may continue for some time in year 2023. And for developing countries, emerging markets, it is important to always bear in mind to fend off the possible negative impact and fallout from those policies, as well as currency fluctuations. So the world should be watchful over recession risks. And that seems like it might be increasing this year and the couple of years to come. So once again, thank you so much, gentlemen. That's been a great discussion. We're actually right on time. Once again, let me introduce to you our guest of the hour. That was Dr. John A. Quelch, Leonard M. Miller University professor from University of Miami Herbert Business School. Thank you. And Mr. Mark Ostwood, chief economist and global strategist of ADM ISI from London, and Mr. Chen Jiahe, Chief Investment Officer of NovMRK Technologies. Thank you so much, gentlemen, for that great discussion. And with that, I'm wrapping up this special edition of Biz Talk here on CGTN. I'm Lulu in Beijing. Till next time, bye for now.